Hi and welcome to this Baillie Gifford live webinar on the Baillie Gifford UK Growth Trust. I'm Katrin Schindler from Citywire, and with me are Milena, Mileva and Iain McCombie, the managers of the trust. And over the next 45 minutes, we'll take a closer look at the challenges and the opportunities it's facing. And the way this works is I'll be picking Milena and Iain's brain in the next 30 minutes, and then it's time for your questions. So if you have any, please submit them at any time via the chat, and then we'll get to them in the last 10 to 15 minutes of the session. And on that note, let's dive right in. Milena, Iain, welcome.
Thank you.
Milena, let's start with you. So the trust has seen a marked fall in its NAV during the last 12 months. So what would you say is behind that drop in performance?
Yes, it has been a very challenging period, 12-month period for performance, and Iain and I are both would apologize to shareholders for what's been a very difficult period. We ourselves are shareholders in the trust, so we share some of that pain. I guess despite the setback, now I'll come and address your question head on. But I guess I'd like to say that despite what's been quite a big setback in short-term performance, we very much remain confident in our portfolio and enthusiastic about the companies we own. We are very long-term investors, and I think in the vast majority of cases, we remain committed shareholders to the businesses we own in Baillie Gifford UK Growth. To come back to your question on what's really been behind that very significant underperformance over the 12 months, I think to simplify it, I'll draw out three main strands, I think, to it. The first one is there's been a number of very large index constituents in the UK. And here I mean the big energy companies, the big banks, the pharma companies. Those have been performing very strongly over the last 12 months as oil prices have clearly gone up on the back of the Ukraine conflict, and interest rates have gone up. We all know about these things. We read about them in the press every day. That's led to these companies outperforming quite strongly. We have no exposure in our portfolio to those big index constituents, which has hurt relative performance. We still don't believe they represent attractive long-term growth opportunities on a 5-year view, 5-10-year view, which is where we invest. But in the short term, they have been painful. I hope that bit is not coming as a surprise to shareholders, in that I think we've always been quite upfront that we construct portfolios which are very different to the benchmark in both good ways, good times and bad. The outcomes will be very different from the benchmark. So that's the first thing I'll draw out. The second thing has really been around companies where, and I think the large majority of our companies fall in that category, where the operational performance has been quite strong or very resilient. And in fact, in some cases, we would argue the businesses are coming out of that very strange couple of years we've had in probably in a stronger shape than they went in 2019. But we have seen marked deratings. The valuations of those businesses have come back quite some way, again, as discount rates have risen. And then the third count really is companies, a few companies where there have been admittedly short-term operational and financial disappointments. I guess an example here is a company we've held for a very long time, Genus, which is an animal genetics company, which faced quite a severe cyclical downturn in one of its big markets in China, in the porcine Chinese market. We still think the case is very strong over the long term, but it has been a bump in terms of short-term operational performance. Other examples I'll draw here, a few of our online consumer companies have faced quite challenging environment. Again, they benefited very strongly from during the pandemic in terms of very, very buoyant demand backdrop. And then coming out of the pandemic, have seen demand normalizing, but also more importantly than that, they're facing some quite significant headwinds from supply chain disruptions, cost inflation in various different inputs. So it's been quite a challenging operating environment for some of these companies in terms of being able to forecast and and run the businesses. But these are really the three main strands I would draw out. I mean, on the third one, there are always in any portfolio, there's always things that don't quite work out the way you want them to in the short term. I guess I suppose in this environment, things are a bit more extreme in terms of share price reactions. But our response is the one that we always take in such situations. We look at it ourselves honestly and challenge ourselves. Is there genuinely a long-term change here, a fundamental change that's happened that undermines the confidence in the hypothesis, the long-term hypothesis behind these companies in this investment? Or is this something we are happy to weather in the short term? So there's always, Iain and I always have, and the rest of our colleagues indeed, always have very active debates on these companies. But hopefully that gives you some feel of what I think are the key drivers behind the performance outcome over this 12-month period.
No, more a combination of reasons than one main factor, basically. So Iain, to bring you here as well, as long-term investors, how do you approach an environment like this? And Milena has already touched on that. It's quite challenging, where the market gets tunnel vision and where things become very short-term out of a sudden.
Yeah, I mean, Catherine, it's a great question. It's a really fundamental question for all investors. And I think Milena really kind of hinted at the answer already, that one of the great things about our team is we've got a lot of experience, and what that means is we've been through both economic cycles and performance cycles, as Milena said, good times and bad times. And what we know from experience is that the thing you've got to do is you've got to stick to your knitting. So that means you still take that long-term view. We're not trying to predict what's going to happen, and we've seen the events in the last week, Catherine, if you're trying to predict what's going to happen in politics, you could have written a lot of stuff and you've been completely wrong because it's all changing day by day. But we don't do that. We don't waste our time on that. What we're trying to say is, where do we think our companies are going to be in 3 and 5 years' time or 10 years' time? That's what's really going to matter for our shareholders, because we think that in the long run, share prices follow fundamentals. So what I can reassure all our shareholders is that we're still sticking to that, because we think that's the right way to deliver, good long-term growth to the shareholders.
Mm-hmm. And now you base. Oh yeah, Milena, keep going. Sorry.
No, I just thought I'd add, in terms of it, we see it as an opportunity in many ways. As what tends to happen, and it doesn't only apply to market downturns, which is the current situation, but actually applies equally as much when markets get very exuberant on the way up. In both of those scenarios, I think there's quite a lot of indiscriminate behavior, and there's not that much regard for company specifics and company fundamentals. So people, the market starts treating businesses that are very different from each other quite often in a very similar way. So that lack of regard for fundamentals, I think, presents an opportunity for us, because we are, as Iain said, where we think we can add value, and of course we'll make mistakes, but hopefully over time, where we can add value is in being very sharp on company specifics and individual company analysis. And I think of times like this, where you do have this tunnel vision, as you described it, and people are quite indiscriminate in the way they treat different businesses, I think is an opportunity for long-term investors.
Mm-hmm. That actually leads nicely to my next question, which is, so which key portfolio themes are you actually focusing on? And are you maybe planning to change them going forward?
Yeah, I mean, we don't really think in terms of themes very much, Catherine, in terms of being a top-down themes. I don't think we clearly are long-term growth investors, so we're always very interested in areas where we can see significant change happening, and the potential for very long-term wealth creation, where things are being done in a different way, in a better way in the economy. And we try to identify companies that benefit from those changes and invest them. But it always really, that's the starting point. It always has to come back to individual businesses, and us being able to, I guess, convince ourselves that we've identified a company that's very well positioned because of its business model, because of the strength of the management behind it, to really benefit from that structural structural threat, trend, or theme, whatever way you want to put it, that we've identified. So there's always different bits we're looking for. I mean, Iain can give his own examples on this. I am quite at the minute quite enthusiastic about changes happening in terms of the digitization of the enterprise. Um, I think a lot of attention has gone into companies that are digitizing consumer lives. We know a lot about them. There've been some very profitable investments over over long periods. Even though, as I said, some of them I think are facing challenges at the minute for a variety of different reasons. Um, but for me, this trend towards the digitization, excuse me, of the enterprise. I think it's a compelling one. So we are looking for companies where that benefit from that over the long term.
Iain, do you want to chime in? Which areas do you think are benefiting maybe from the current environment even?
Well, Catherine, I could probably talk for another 20 minutes on that, and you probably wouldn't thank me for that. But I mean, what I would say it's really important is that I'm sure we'll talk about growth being out of favour that Milena had hinted at, but I think the kind of thing that we would sort of really stress is that if you look at the fundamentals, disruption is still happening, and what we're just really simply trying to do is follow the growth. Milena's a great example of that, and there's plenty of other examples in the portfolio. But the whole portfolio is full of growth businesses. That's why our portfolio looks very different from the index, because we think there are a lot of companies, well-known companies, which we don't think don't exhibit long-term growth opportunities for us. Whereas the businesses we think do, and we think if we're patient, and that's really almost another way to think about it. You've got to be patient as long-term owners, and to let the kind of fundamentals do the talking, not us. The businesses are getting stronger every day, we think, and that's the kind of key thing that matters.
Mm-hmm. Now, it's not only the strong tilt towards growth stocks that makes your portfolio different to the benchmark, but it's also the fact that you have a strong bias to mid and small cap stocks when compared to the benchmark. Why is that the case? Milena, Iain?
I'll do it. I mean, I think if Milena was here, she'd probably be kicking me under the table when we were sitting side by side, because Milena hates us talking about even things like mid and small companies. I mean, and she's absolutely right, because what we're trying to look at, our companies growth businesses or not. That's how we look at it, Catherine, rather than look at kind of categories. And we're really agnostic about where we find the growth. So it just happens to be at the moment we find more of the growth opportunities in the mid and small areas, as you asked, and you shouldn't be surprised by that, I don't think, because it's almost like the law of small numbers. It's much easier if you're say a £1 billion company to double than if you're a £50 billion company. So you'd imagine that we were always going to have a bias towards those types of companies. But just to be clear, it doesn't mean that we're not against. We like big companies if they exhibit growth. So something like Experian, which is one of the biggest companies in the UK, but it's a fantastic business with great growth opportunities, and we've got a big holding in that. So it's not. We try not to look at categories. We look at the individual fundamentals. That's what bottom-up stock picking is about, really.
Milena, did you want to say anything? You look like you want to add a comment.
No, not at all. I completely agree. Iain's put it very well.
Wonderful. Now, talking about growth stocks, we can't really talk about that without also mentioning that they have taken quite a beating recently. So would you say that the current de-rating of growth stocks marks the end of an era, basically? Smiling from Milena.
Yeah, I'm always weary when big pronouncements are being made around these things. I mean, look, our view is that, and that's not changed at all, is that share prices follow fundamentals, long-term fundamentals ultimately. And that's how we invest. So as Iain said, I think our job is to follow the growth, find the areas, and more importantly, actually the businesses in those areas that can deliver that very superior long-term growth in revenues and in earnings, over 5-10 years, which is how we invest. So that's what we are looking at. I think we are less concerned with changes in sentiment over the short term. I think over longer periods of time, share prices will follow fundamentals.
Mm-hmm. Now, to change that a bit, we talked about how you find opportunities, how you identify companies you want to invest in. But what does if we look at the other side of the picture, what does your sell discipline look like? Iain, do you want to go for that one?
Yeah, I mean, I think the first thing to put it in context, Catherine, our portfolio turnover is very low compared to most funds, or you'd see. I mean, it's low single digit. So we're owning companies. When we say we're owning companies for 10 plus years, we're not just saying that's the actual reality of the situation. But I mean, just to be clear, just because sometimes people think because you're a growth investor, you don't care about valuation, and that's not true. That's not the case. And actually, I can give you kind of a few examples recently of kind of companies that actually have held up better than some of our other growth companies. Probably I'd call them more steady Eddie type companies. So things like RelX and Bunzl, very good businesses that are still kind of churning out the kind of growth, but they've held up much better than other companies, and so the valuation is looking a bit more challenging. So we take a little bit of money out of them to reinvest it in some of the areas that Milena was talking about, where companies where the fundamentals are also strong, but there's been a derating. So actually, that's an example of where we're always looking at existing holdings, but equally we'll also look at companies where the investment case Milena had said right at the start hadn't worked out. And an example of that was James Fisher, which is a marine service business. Some very good businesses within it, but unfortunately they've made one or two very bad acquisitions, and the story has kind of deteriorated. The balance sheet isn't that strong, so we decided it's not worked out for us, so we just sold it and moved on. So we will make mistakes like that, but by and large, we try and stick with companies when they're going through tough times, because we think in the long run, as long as the fundamentals are doing well, we stick with them. But if the fundamentals are deteriorating, we wouldn't hesitate to sell.
Mm-hmm. And you're not only looking for opportunities in the public space, but also in the private space. So what percentage of the trust is currently invested in unlisted opportunities? First part of the question. And then second part, how do you go about sourcing those private market opportunities?
We have a permission from shareholders to invest up to 10% of the assets of the trust in private companies. We are currently very far away from that ceiling limit. We only have one private investment so far, Catherine, which is a company called Wave, which is trying to solve the problem of autonomous driving at scale. We think an early business, but quite an interesting one, and with a pretty differentiated approach. But that company is a very small position, partly reflecting the maturity of it, at around 40 basis points or so in the trust. So we are still very far away from our limit of 10%. We are looking for private opportunities that are genuinely additive in terms of things we cannot find in the listed space in the public markets, things that genuinely will add to the quality and the growth of the portfolio. I think that's the top level kind of principle, really. We work very closely with our private companies team here in Baillie Gifford. They are significant help when it comes to the sourcing of the opportunities, but also the research as well. So we very much unashamedly lean into their expertise, as well as our own efforts in doing the due diligence and whatnot on the individual investment.
So you're not planning to... Oh, sorry, Iain, did you want to say something? Did I interrupt you?
Well, I was going to add, Catherine, that I don't want to give the listeners the impression that we don't find opportunities in the listed area. That actually, perhaps one of the kind of the good things about the kind of current market environment and shakeout is that we're probably our pipeline of new ideas in the listed area is probably as high as it's been for a number of years. So actually, I don't want to get the impression that we look in both areas, both listed and unlisted, for ideas, but it's not just always just an unlisted area. Just to make sure that's clear to everyone.
And yet my next question also focuses on the unlisted space, because listed markets have fallen quite heavily recently. So I know, Milena, you already answered that kind of, but are you planning to put more emphasis on unlisted opportunities, maybe in the short term?
No, not necessarily. I think I'm with Iain. I think there's loads of interesting opportunities cropping up of new holdings, things we don't own, companies that we've admired for a long time in the listed space, but say valuation has been a stumbling block. There's a few of them cropping up that we are working on. That I think there's more in the listed space currently so I concur with Iain on that. It's also just, as I said, there's no we just kind of go where the ideas take us. If there's a few interesting things in the private space that we're considering. There's nothing imminent on those, but we're just looking for the best ideas, whether it's private or public. We're indifferent up to the limit that we have agreed with shareholders.
Yeah, and a couple of real examples, Catherine. We bought holdings in Kainos and Softcat, which were kind of, as Milena said, companies we've been admiring for a long time. We've just been waiting for them. And this point about patience, that sometimes it can be a bit, so why do we wait? And you never know, you might get that opportunity. Well, the market kind of deratings come, the fundamentals of those businesses are still strong. So we said, great, this is the opportunity we've been waiting for. So that's the kind of the sign of it. It's starting to kind of turn. So as bottom-up stock pickers, the paradox is, despite all the turmoil, we're getting quite excited at the moment. So,
based on that, are you planning to expand the trust gearing?
I think we yes. Well, we'd like to. I mean, the one thing that's kind of held us back a little bit is partly just kind of sales. We've had one kind of company that was bought out, quite a big holding called Ultra Electronics, and we've also got a couple of other ones where the bids have been approved, which is kind of mixed news because they're up a lot, but equally we like both business, HomeServe and Euromoney. So we've got sources of funds first before we kind of come to it. But I think in the long run, we would like to have a higher level of gearing than we currently have, but and we've got permission from the board and so on to go up to, I think it's under 10% of shareholder funds. So we're about 2% or something at the moment. So we're a long way from that, but very much on a bottom up basis. We don't try and call the market and that. It'd be kind of very much, we find individual ideas we like.
Mm-hmm. Now, one last question from Iain before we move on to the audience questions, which is, so your portfolio is relatively concentrated with about 35 to 65 stocks. Are you planning to increase that number anytime soon?
No, I mean, we're actually about 46, 47 at the moment, and we're kind of pretty comfortable at that level. And that's been pretty much the same since we took over the trust.
Wonderful. Then let's move on to the audience questions. There's one that says, how do you discern long-term growth prospects from shorter-term ones? Who wants to take that one?
Oh, it's a great question. Yeah, I mean it's a fantastic question. It's very hard sometimes because a company can grow very incredibly well in the short term, but that can prove to be fairly short-lived because I don't know, competitors catch up, the industry evolves. And this is what makes our job as rewarding as it is, because it is trying to really focus on the long-term development of competitive dynamics and industry structures. And there's a hell of a lot of uncertainty when it comes to making those judgments. So you try your best, but ultimately, you are trying to forecast something with a great degree of uncertainty. But we think it's important to focus on the long term and trying to make those judgments as well as we possibly can and as well informed as we possibly can. But we're not. What I can say is that we're not tempted by high short-term growth. For us, the key question we always try to convince ourselves is the one around: is this growth sustainable on a 5-10 year view? Do we believe something genuinely strong here around that company, the way its business model, its competitive position, it's the people that run the company, the corporate culture, some of the more intangible aspects in some ways that lead you to have that confidence over in the sustainability of long-term growth. But it's a terrific question because sometimes it's very alluring. High growth in the short term can be very alluring, but you have to be quite disciplined on keeping the eyes in the very long term and trying as best as you can with all the uncertainty involved to make the right judgments.
Wonderful. Iain, did you want to add anything to that?
Yeah, well, I'm glad Milena answered it first because she did a better answer than I would have. I think Milena's one of the points I think is really interesting is that point about the kind of culture that she was hinting at, that it's a thing that people don't talk about, particularly at times of crises. Yet in some ways, I think they're really important, because what you often see in real life is that when companies come through a crisis, if they're really good, they've actually probably strengthened their market position. So even in the short run, it might be tough, but actually in the long run, it's in an even better position. And one example that I thought was quite interesting recently was Howdens, the kitchen kind of company. They do kind of sell to the trade, kitchens, and they're number one player in the UK. And one of the things they did from a cultural perspective, which I think might be interesting for shareholders, is that they paid £500 to every member of staff, and this is to do with the cost of living, the kind of energy bill kind of crisis. Now, you might say, well, that's going to cost them a lot of money, and it's cost about £7 million. But for us, as kind of the managers and on behalf of the shareholders here, we think that's really good news, because it shows that this is a company that cares about its staff. The staff have really responded well to it, so we've been told, and that to me is really important. When you're going through tough times, you've got well motivated staff who like the business that they're working for and think that the management are kind of trying to be on their side. And I think in the long run, that's what I'd call a winning culture. And you will get the benefit from that. Even in the short run, you might say, well, that's not a good thing. And we think in the long run, that's really important, because we all know that, if people like working for a business, you can tell the difference between that and a business where people couldn't care less. And we've been in shops where you can tell the difference of that.
Now, you just gave an example of a company that shows how it can be done, a good example, a poster child for good stuff, basically. But this question refers to companies that maybe risk collapse due to changed economic climate and increasing interest rates and so on. So the question is, have you identified any companies that are like that? Or in other words, is the portfolio sound? Milena, I don't want to put you on the spot again. So Iain, do you want to answer that one first?
Look, it's always hostage to fortune, isn't it? You say that, and we spend a lot of time looking at that. And if you look at the kind of aggregate numbers, the balance sheets of our companies on average is much better than the average. So, which hopefully we'd say is because we're looking for good quality businesses. But equally, we're looking at that point at the moment in terms of stress situations. And it's very similar to what we went through with COVID. We did that exercise then. So this is not a kind of unprecedented situation where we had quite a severe kind of trading thing. And in that case, most companies we owned actually held up really well, and we didn't have to make many changes to the trust at that point. So so far, I'm not saying there won't be tough times, and I think that's really important. We're not trying to claim that we can buck the market or the economy or things like that. And it's not just the UK economy; it's kind of globally. But our most of the companies we have are in pretty good shape. Don't forget, people are the great financial crisis is still, most finance directors still remember that really well. They remember COVID really well. I think actually the quoted sector, well, certainly the companies we're looking at are not too bad shape. But I'm touching wood when I say that, probably in my head, I think, just to kind of make sure. But you can probably come back and kind of criticize me later if I get one of these ones wrong. But I think overall we're sleeping sound. I think that's the main point.
Now, this person says that there are too many companies in the trust that don't really look like they are internationally competitive or scalable, for example, Games Workshop. And the person is asking, are there not better companies with a unique R&D or intellectual property in the UK to invest in?
Well, we are open to ideas, including if they come from our shareholders. We would love to hear about them. We are looking for companies. Just to respond to the question, that have that fantastic R&D and IP in them. We happen to think Games Workshop is a company that has really quite terrific intellectual property. The proof would be in the pudding, as it were, whether they'll be able to monetize that intellectual property outside of the very successful core business in tabletop gaming. I think, the jury is still out on that. I think the potential is very compelling, and we happen to think that the management team are very, very impressive and very strong. So we hope they will execute on that opportunity, but time will tell whether we are right. But the Games Workshop is a very global business. It has grown fantastically well outside of the UK. It is growing very, very well in the US in its core business. But I think that question around the IP being monetized more broadly in new areas is an interesting one, important one, and time will tell whether they'll be successful in it. But we are open. The kind of description that was given is exactly the kind of companies we like. So we're open to ideas
Always open for
from
suggestions.
everywhere.
Great stuff. Now the next question wants you to compare the UK Growth Trust with the US Growth Trust. So how does the quality and value of the portfolio compare with it based on price, profitability, and growth prospects? What would you say? Iain, do you want to start with that one?
I think Milena's looking very happy because I'm answering that one. Well, look, I'm actually a shareholder in the US Growth Trust too, so I like it too. So don't. I know Gary and Kirsty well. I think it's a very different trust. I mean, they've got. I think my understanding is they've got a much higher unlisted weighting than we have. We're just starting really, but that's obviously understandable because the US market's much more advanced in terms of unquoted. But look, I don't have the numbers to hand on that question, Catherine. But I mean, I think some of the things that Milena said at the start, growth being out of favour, I think they've probably been hurt by the same types of things. I suspect they've probably got more growthy companies. But I think the thing I always say about that is it's not just the kind of the numbers; it's the kind of what's the chance of actually making that. So a lot of our companies, we do have some of these companies that are, very high growth. We have other companies such as, like Bunzl is a great example that it sounds, people call it boring Bunzl, but it's grown its earnings at 10% per annum for 25 years. Now, that is one of the best performers in the UK market, and you've made multiples of your money. So, it's not the most exciting story, but it's actually a really well managed business that has got that competitive advantage. So you've got a high probability they can make that type of growth. Some of these other businesses that we own, and perhaps the US, they have higher potential growth, but there's risks to that too. And that's always what Milena and I are always kind of trying to figure out with some of these companies. And that's what we've got in our trust. I'm much easier talking about we've got, that we have that nice blend of, some of these companies that are perhaps, steadier growth, and then we've got some really exciting growth businesses as well, which, if they turn out as well as we do, they're going to be real game changers for the trust. But we haven't kind of sunk all our money into them. We've got them all, sized appropriately, we hope.
Mm-hmm. And Milena, Iain, you both mentioned earlier that mistakes were made. So have you revamped your process of selections based on that? Any lessons learned? It's a tough one, sorry.
No, it's an important one. I just don't know how you generalize it. I mean, we always agonize a lot over individual mistakes. I'm probably worse for it than Iain. Iain's more sanguine, probably rightly so. I'm the one that just agonizes a hell of a lot over individual mistakes. But it's hard to generalize because the factors behind them are quite often different. I don't know, Iain. What's your take on that?
I mean, the thing what I'd say, Catherine, is look, we're in the risk business, and we to outperform, you have to be different from the benchmark, and there's a chance that you'll get individual things wrong with that. What's really important in terms of the process point, I think, is that you can't eliminate mistakes. We would sort of say that if you run a process that you're making no mistakes, you're probably not taking appropriate risk to generate outperformance, because you're almost too worried about what can go wrong rather than what can go right. And that's a very important thing at Baillie Gifford that that Milena and I think we strongly believe in, is that you've got to think about the kind of the what can go right question as well as what can go wrong. So I think, just to be clear, I worry, I agonize about mistakes. This is probably as much. I just don't show it as much, perhaps, as Milena. But I think what you can't do is say, I've made a mistake, therefore I'm not going to take any risk again in the future, because actually I'm not doing my job or our jobs properly. Because you have to, as growth investors, look for businesses which we think could be transformational or could be a much bigger size than they are in 5 or 10 years' time. Now, there's always a risk attached to that, but we think that we do appropriate due diligence, but sometimes you just get it wrong. Sometimes it's maybe our analysis was wrong, and that's what we probably agonize about. Sometimes it's about, just things change, markets change, consumers' preferences change, and that's it. And, you can't, as Milena said, you can't generalize, but I think we do, just to be reassured, we don't sit here and look at things and don't worry about it. We worry a lot, but equally, we've got to focus also on the upside and to be optimistic, because in the long run, if you bet against optimism, you're betting against the stock market growing, and I think that's a big mistake.
Good answer, I would say. From looking back, now let's look ahead to the future, because we also have a forward-looking question here, which says, do you think that there's going to be a UK recession, and what impact would that have on the forecast earnings growth of the trust? I don't want to put one of you on the spot. Sorry.
Well, look, we're not macro forecasters. So I've no idea what the stock market's going to do in the next 12 months. I don't know what the UK economy is going to do now. I don't know if that can potentially sound a little bit flippant. We clearly know it's going to be tougher from here. A rising interest rate environment is not good for growth. We all know that, but the question for us is, I think, as an analogy somebody used, a management team used, we're cycling uphill. We know that things are going to get tougher from here, but the question is, is our equipment good? Is our technique good? Are we working as a peloton, to kind of get up there? Because what matters is not just the fact it's climbing, but what happens when you get hopefully to kind of flatter ground, or perhaps the ground becomes easier again, and that's the thing that matters. So when you're looking at companies on a 5-10 year view, stuff's going to happen that's going to be tough in that period. But what we're really focused on is, are they still doing the right things for the long run? Because we don't want to sell companies that we think are going to be in an even better position, even though they might struggle for 1 or 2 years because the economy is tough. Because actually, the reason for that really is because it's tough enough in our job trying to get the market time, or get the timing of buying a stock right. But if I say to you, Catherine, right, I'm going to sell this company because I think there's going to be a recession in a year's time, well, I'm making one decision now, but then I've got to make another decision. If I really like it, I want to buy it back again. But what happens if I get that timing wrong, or what happens if there's not a recession? Then I've looked a bit of an idiot. So that's the type of thing that why we can have low portfolio turnovers, because we think actually the key decision is actually to find a really above average growth business and try to hold it for as long as you can. And not going to get swayed too much by what's going on, because in the long run, we'll get through a recession. We know we're going to, if there is one or not, we know times are going to get tougher, but things will get better at some point. That's what always happens. And it's try not to focus too much on the near term. It's very tempting, but that's almost what you said to your first question to me, is about, looking long term, is we've got to try and focus long term, because if you always focus on the short term, you're missing that longer term picture. I'm not sure that's the answer for you.
That also ties in nicely with the next question, which is, do you compare your UK companies to your European and US peers to make sure they actually stack up? Milena, do you want to go for this one?
Yeah, we do that a lot, Catherine. I think it's a great strength we have in Baillie Gifford, in that we all sit together on the same investment floor, and colleagues. So we speak a great deal with colleagues that cover companies all over the world. There's many formal and informal mechanisms that we can effectively do this. So the answer is yes, we do it, and we think it's quite important actually, because our businesses are very global, and very often there is an interesting peer and equivalent somewhere else. So it's very informative to be able to do this with colleagues. So we try to do it a lot.
Great stuff. And then maybe one final question before we wrap it up. This person is asking, how long would you be prepared to accept a lack of short-term performance of the portfolio? So how patient are you in that regard?
It's another really great question. I think we have to sort of keep saying, as long as it takes, as long as the fundamentals of our portfolio remain strong, then we're going to stick with those companies. It's the biggest killer of fund managers is not some health thing, it's style drift. that if you kind of say, well, actually, this isn't working, let's do something different. But hopefully, we've set out our stall very much when we took over the trust of what we're trying to do. And just to be clear, we have a kind of a consistent philosophy, but that means it's very open-minded. We're following the growth. So it doesn't mean that the companies won't change over time. If we think there are better growth opportunities, or we can improve the quality of the portfolio, we'll do that, no problem. But we're not going to change our long-term investment philosophy or for growth investing, because we think in the long run it pays dividends, and and it'll go literally, and also kind of capital growth, and we think that's the best thing to do for the trust and the shareholders, and we're just sticking to that. And I should also say we've got a very supportive board who kind of make sure that we're kind of sticking to that. But I think that's really helpful to kind of make sure that we stick to that, because they know that they think that's really important for us too, and we agree with that.
Wonderful. Milena, is there anything you want to add on that one? Or did Iain say it all?
I think it summarizes greatly. So
wonderful. Thanks so much, both. That was delightful.
Thank you.
Thank you.
Thank you so much for watching, and see you next time.